So how do the numbers look? All right, well, look, the growth here is extraordinary. Last year, DoorDash's total orders increased by, it's hard to believe these numbers, 217%. Gross order volume was up 186%. Revenue grew at an astounding 204% clip. In the first 9 months of 2020, those figures are holding up. Total orders decelerated a tiny bit to 198%. Gross margin order volume accelerated to 200%. Revenue growth accelerated to 226%. Wow. Share and growth. Fantastic. What can I say about a company with 200% revenue growth? Well, that's even better than Snowflake. And they've done it in 2 years in a row. And when you drill down quarter by quarter, the numbers have been accelerating dramatically over the course of 2020. But, and this is a big but, obviously 2020 is a unique moment. Remember, late last year, DoorDash acquired Caviar, meaning not all the growth is organic. Snowflake is organic. Plus, on top of that, they're getting a major boost from the pandemic. That makes it tough to figure out how quickly they'll be able to grow in the future if and when the pandemic is finally, under control. How about profitability? While DoorDash is still far from profitable, their margins are headed in the right direction, and fast, to the point where they're actually generating positive earnings before interest, taxes, depreciation, and amortization. I did not think that was possible this fast. These gig economy plays also like to talk about what's called their contribution margin, what they make after you subtract all sorts of variable costs like marketing and stock-based compensation. And in the case of DoorDash, the contribution margin swung from negative 2% last year to up 3% in the first 9 months of the year. And that's about what we'd expect, given that the on-demand delivery business has become a lot less competitive in the past 12 months because of all of the agglomeration. It's been incredible. You used to be able to pit these guys against each other. Remember, I own a restaurant and a bar. I know these things. My big concern here is that DoorDash is coming in hot. The numbers are fabulous right now, but we don't know how much of that is sustainable. So I expect the IPO to catch fire right out of the gate, even as I worry that it's destined for a pullback when the growth slows in 2021 and the company's up against some very tough comparisons. We know DoorDash plans to come public at a $90 to $95 price range. Final price should be announced tomorrow. At the midpoint, we're talking about a $30 billion valuation. And you know what? Based on the estimates from D.A. Davidson, the stock would be trading at less than 7 times next year's sales estimates. I know people say, oh, come on, Jim, we care about earnings. Fast growth, you do it by sales, all right? It's pretty cheap for a company with 200% growth, although it's more expensive than its slower-growing peers like Grubhub. Given that DoorDash's growth is expected to slow to 56% next year, I'd be hesitant to give it a cloud-style valuation. I think $100 is a reasonable price, though, but I doubt you'll be able to get it that low. Here's the bottom line. DoorDash is a terrific story, but its business could slow substantially next year. So I recommend being careful with it. If you can get it for $100 or less, you got my blessing. Otherwise, sorry, you had to get in on the deal because you can't chase these. You just can't.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.